Welcome to ZICA Academy YouTube channel. In this lecture, I want to examine vertical group, plus, and associates. If you are coming across my lecture for the first time, please like the video, also share it with others. If you are a returning subscriber, I say thank you for being part of this channel. Vertical group, sub-subsidiaries. When you say vertical group, we are referring to sub-subsidiaries. A sub-subsidiary is an entity that is controlled by another entity, which is itself a subsidiary of the parent. An entity that is controlled by an other entity, which itself is controlled by the parent company. For instance, example, H acquired 80% of the equity interest of S1 on 1st of January 2023. When the retained earnings of S1 was 50 million naira. S1 acquired 60% of S2 on December 31st, 2024, when the retained earnings of S2 was 30 million naira. The retained earnings of S1 on December 31st, 2024 was 45 million naira required. 1. Determine the effective interest of H in S2. 2. The pre-acquisition retained earnings of S1 and S2. Now, suppose you are given this as a question. So, the first thing is to draw the group structure. That is the starting point. Solution. Or let me draw it here. Group structure. Group structure. You were told that H acquired 80% of the equity interest of S1. That means you have H acquired 80% of the equity interest of S1. And the date of acquisition is January 1st, 2023. When the retained earnings of S1, retained earnings of S1 as at that date is 50 million naira. S1 acquired 60% of S2. S1 acquired 60% of S2 on December 31st, 2024. The date of acquisition is December 31st. December 31st, 2024. When the retained earnings of S2 was 30 million, retained earnings of S2, retained earnings of S2 was, when the retained earnings of S2 was 30 million naira. Then the retained earnings of S1 on December, this they are referring to this same day, that of S1 was 45 million. Required, determine the effective interest of H in S2. S2 is a sub-subsidiary of H because S2 itself is a subsidiary of S1, which is itself a subsidiary of H. Remember, I've told you that a sub-subsidiary is an entity that is controlled by another entity. This is the another entity we are referring to here. Entity that is controlled. This S2 is what we are referring to. S2 is a sub-subsidiary. This S2 is a sub-subsidiary. We said a sub-subsidiary is an entity that is controlled by another entity. Another entity here is S1, which itself is subsidiary of the parent. That is why we say a sub-subsidiary is an entity that is controlled by another entity, which itself is a subsidiary of the parent. S2 is controlled by S1, and S1 itself is a subsidiary of the parent company. Therefore, S2 is a sub-subsidiary of H. Please take note of that. Now, when we are given a problem involving a sub-subsidiary, the first thing is to determine the effective interest of H in S2. The effective interest of the parent company in the sub-subsidiary company. And to do that is very simple. The effective interest of H in S2. H in S2, that will be 80% multiplied by 60%. That gives us 48%. This shows that H will be exercising an indirect control of S2. Therefore, NCI will own the remaining 52%. Total will be 100%. Don't say because the NCI owns a larger percentage that S2 is not a subsidiary. No, S2 is still a subsidiary in as much S1 control S2. Therefore, H will be exercising an indirect control of S2. Now, we've determined the effective interest of H in S2. Now, the next requirement is the pre-acquisition retained earnings. Now, to determine the pre-acquisition retained earnings is the retained earnings of the sub-subsidiary company as at the date the control is achieved. Pre-acquisition retained earnings is the retained earnings of the sub-subsidiary company. As at the date the control is achieved. Since H had acquired S1 before S1 acquired S2, it means the very day S2 was acquired is the date S2 become a sub-subsidiary company of H. Therefore, the retained earnings as at the date S2 was acquired is the pre-acquisition retained earnings. But if if S1 had acquired S2 before H acquired S1, it means H hasn't gained control of S1 as at the date S1 acquired it, because S1 had acquired S2 before the S1 itself were later acquired by H. So that means the date H acquired S1 is the day S2 will become a sub-subsidiary of H. Therefore, the retained earnings as at the date H acquired S1, the retained earnings of S2 as at the date H acquired S1, that retained earnings will be the pre-acquisition retained earnings. So in this case, the pre-acquisition retained earnings of S1, the pre-acquisition retained earnings of S1 is 50 million, because the day H acquired S1 was the day H gains control of S1. Then what is the pre-acquisition retained earnings of S2? The day S2 was acquired, that is the day S2 become a sub-subsidiary to H. So that means control is achieved as at the date S2 was acquired, which is December 31st, 2024. Therefore, the retained earnings of 30 million is the pre-acquisition retained earnings of S2. So these are the pre-acquisition retained earnings. Pre-acquisition retained earnings of S1 is 50 million. That of S2 is 30 million. This 45 million is useless. Treatment of consideration. Consideration paid by the subsidiary company in acquiring the sub-subsidiary company. The consideration, remember, based on my earlier illustration, H acquired S1, so acquired 80%. When H acquired 80% of S1, certain consideration will be paid. That consideration will be used in calculating goodwill on acquisition of S1. Then when S1 acquired S2, S1 acquired 60% of S2. Another consideration was paid by who? By S1. S1 paid certain amounts to the shareholders of S2 in acquiring the 60%. That is the consideration we are particular about this time around. This consideration will not be used in calculating goodwill directly. The latter consideration, the consideration paid by the subsidiary company in acquiring the sub-subsidiary company, will not be used in calculating goodwill. The total consideration, we don't use it. This consideration, you will divide it into two. Parent and NCI. Remember, the stake of parent is 80%. It is this 80% that will be used. While if 80% belongs to the parent, the remaining 20% belongs to NCI. So the 80% stake, that is the parent shares of that consideration, the parent shares, remember the consideration we are talking about is the consideration paid by S1 in acquiring S2. That is the one we are talking about, not the consideration paid by H in acquiring S1. The consideration paid by S1 in acquiring S2, that is the one we are talking about. So this consideration, I said it will be shared between the parent company and NCI. It is the parent shares of that consideration that will be used to calculate goodwill. It is this 80% of the consideration paid by S1 in acquiring S2 that you will use in calculating goodwill. The NCI shares of it, you use it to reduce the non-controlling interest calculated in usual way. You will understand this question better by the time I take questions as work example. In this video, I will solve question number 1 of ICAN November 2023 corporate reporting. So, the NCI share, which is 20%. So, reduce NCI. Reduce NCI by the NCI share of the consideration. Reduce NCI by the NCI share of the consideration. It means the NCI shares of the consideration you have apportioned between parent and NCI. When you calculate your NCI in usual way, the same way we have been calculating our NCI, the same way it will be done here. So the NCI, you now subtract the NCI share of that consideration from the NCI calculated in usual way. By the time I take questions as work example, you will understand it better. Please watch this video to the end for better understanding. Now, consolidation procedure. That is the procedures for consolidating the sub-subsidiaries. Step number 1 is to draw the group structure. Draw the group structure. After the group structure, the second step is determine the effective interest of the parent company in the sub-subsidiaries company. Three, present share the consideration paid by the subsidiary in acquiring the sub-subsidiary company. Share the consideration paid by the parent, by the subsidiary in acquiring the sub-subsidiary company between the parent and the non-controlling interest. Remember the usage of each result. The parent share of that consideration, I've told you it will be used in calculating goodwill on acquisition of the sub-subsidiary company. Why the NCI share of the consideration? I said it will be used to reduce the NCI calculated. Step 4, present the summary of the net assets of each of the summary of the net assets of the subsidiary and the sub-subsidiary. Present the summary of the net assets of the subsidiary and the sub-subsidiary company. Step number 5. Calculate the goodwill. Calculate the goodwill on acquisition of the subsidiary company. Step number 6, also calculate goodwill on acquisition of the sub-subsidiary company. Calculate the goodwill on the acquisition. Calculate goodwill on acquisition of the sub-subsidiary company. Note, positive goodwill may be aggregated. While offsetting is not allowed. What I mean by that is, where the goodwill of the subsidiary company is positive and that of the sub-subsidiary company is negative, I said you cannot subtract the negative goodwill from the positive goodwill. Only the positive goodwill should be consolidated. The treatment of negative goodwill depends on the parent company's policy. Where the parent company's policy is proportionate share of the subsidiary net asset, the negative goodwill, which is called gains on bargain purchase, you add it to the consolidated retained earnings. Where the group policy is proportionate share of the subsidiary net asset, negative goodwill, that is gains on bargain purchase, should be added to the consolidated retained earnings. But where the group policy is fair value, you should share the negative goodwill between the parent company and the NCI. The parent shares of the negative goodwill should be added to the consolidated retained earnings, while the NCI shares of the negative goodwill should be added to the non-controlling interest calculated in usual way. But if you don't want to do that, to follow my teaching, to follow it up based on my principle, instead of you sharing it between parent and NCI, I've told you, you can add it to the post-acquisition retained earnings of the subsidiary company in the summaries of the subsidiary's net asset. So that means in the summary of the subsidiary net asset, if you add it to the post-acquisition retained earnings of the subsidiary, that means you don't need to share, since the post-acquisition retained earnings will still be shared. So that means indirectly you are sharing it. If you don't want to share it, because you might forget to share it, just know that where policy is fair value, add it to the post-acquisition retained earnings of the subsidiary in the summary of subsidiary's net asset. So follow it up. Now, number 7. Now the goodwill has been calculated. The step 7 is to calculate the non-controlling interest. Calculate the, let me say, consolidated retained earnings. Calculate the consolidated retained earnings. So this is not different from what we have been doing. So I'm not repeating those formats I've done in my earlier videos, because I believe you already knew how to present the summary of subsidiary net asset. You know those items to be included there. If there are still issues, please go and watch my earlier videos on group accounts. I have over 20 videos on group accounts only. So if you watch them, please, for better search or to ease your search. So if you are searching for corporate reporting video, just type ZICA Academy corporate reporting video. And if it is SBR, ICAN Academy strategic business reporting videos. So you will see all the videos organized in a playlist. Or if you know how to search for playlist, search ZICA Academy, then at the top, click on playlist, then look for the subject of your interest. So you will see all the videos on a relevant course organized in single place, in the same place. Now, step number 8 is to calculate the non-controlling interest that will be included in the consolidated statement of financial position. Calculate the non-controlling interest that will be included in the consolidated statement of financial position. I haven't given you the steps you need to follow when preparing the consolidated statement of financial position. Now let's take a question as work example. Please keep watching. ICAN November 2023 corporate reporting question number 1. Sports PLC is a company which operates in the service sector. The financial position of these companies as at September 30, 2020 are stated below. We have Sport PLC, Football PLC, Volleyball PLC, amount in million naira. Non-current assets, which include property, plant, and equipment, 1,840, 600, 620. Investment in subsidiaries, Football PLC, 1,460. Volleyball PLC, 640. Investment in Handball PLC, 96. Intangible assets, 396, 60, and 70. Total of the non-current assets, 3,792, 1,300, and 690. Current assets, 1,790, 960, and 500. Total assets, 5,582, 2,260, and 1,190. Equity and liabilities. Ordinary share capital, 1,840, 800, and 400. Other components of equity, 146, 74, and 50. Retained earnings, 1,790, 884, and 278. Total equity, 3,776, 1,758, and 728. Non-current liabilities, 990, 246, and 186. Current liabilities, 816, 256, and 276. Total liabilities, 1,806, 502, and 462. Total equity and liabilities, 5,582, 2,260, and 1,190. The following information is relevant to the preparation of the group's financial statements. 1. On October 1st, 2018, Sports PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash of 1,460 million naira. At acquisition, the fair value of the non-controlling interest in Football PLC was 590 million naira. On October 1st, 2018, the fair value of the identifiable net assets acquired was 1,670 million naira, and retained earnings of Football PLC were 638 million naira, and other components of equity were 54 million naira. The excess in fair value is due to non-depreciable land. Note 2. On October 1st, 2019, Football PLC acquired 80% of the equity interest of Volleyball PLC for cash consideration of 640 million naira. The fair value of 20% holding of the non-controlling interest was 144 million. A 30% holding was 216 million naira, and a 44% holding was 322 million naira. At the date of acquisition, the fair value of the identifiable net assets of Volleyball PLC was 724 naira. The retained earnings were 212 million naira. And other components of equity were 40 million naira. The excess in fair value is due to non-depreciable land. It is the group policy to measure the non-controlling interest at fair value at the date of acquisition. Both Football PLC and Volleyball PLC were tested for impairment as at September 30, 2020. The recoverable amounts of both cash generating units, as stated in the individual statements at September 30, 2020, were Football PLC 2,850,000,000 naira and Volleyball PLC 1,208,000,000 naira respectively. The directors of Sport PLC felt that any impairment of assets was due to poor performance of the intangible assets. The recoverable amount has been determined without consideration of liabilities, which relates to the financing of operations. 4. Sports PLC acquired a 14% interest in Handball PLC on October 1st, 2018 for a cash consideration of 36 million naira. The investment was accounted for under IFRS 9 financial instruments and was designated as fair value through other comprehensive income. Fair value through other comprehensive income. On April 1st, 2020, Sport PLC acquired additional 16% interest in Handball PLC for cash consideration of 54 million naira and achieved significant influence. The value of the original 14% investment on April 1st, 2020 was 42 million naira. Handball PLC made profit after tax of 40 million naira and 60 million naira for the years to September 30, 2019 and September 30, 2020 respectively. On September 2020, Sport PLC received a dividend from Handball PLC of 4 million naira, which has been credited to other components of equity. Sport PLC, note 5. Sport PLC purchased patents of 20 million naira to use in a project to develop new products on October 1st, 2019. Sport PLC has completed the investigative phase of the project, incurring an additional cost of 14 million naira, and has determined that the product can be developed profitably. An effective and working prototype was created at a cost of 8 million naira. And in order to put the product into condition for sale, a further 6 million naira was spent. Finally, marketing costs of 4 million naira were incurred. All of the above costs were included in the intangible assets of Sport PLC. Note 6. Sport PLC intends to dispose of a major line of the patents business operations. At the date the held for sale criteria were met, the carrying amount of the assets and liabilities consisting of the line of business were: you have property, plant and equipment, 36 million naira. Inventories, 98 million naira. Current liabilities, trade payables, 6 million. It is anticipated that Sport PLC will realize 60 million naira for the business. No adjustments have been made in the financial statements in relation to the above decision required. Prepare the consolidated statement of financial position for Sport PLC Group as at September 30, 2020. Now, the name of the entity is Sport PLC Group. We want to have the solution to the question. Sport PLC Group. And the first step is to draw the group structure solution. The starting point is the group structure. Group structure. We were told on 1st October 2018, Sport PLC acquired 70% of the equity interest of Football PLC. So we have Sport PLC acquired 70% of the equity interest of Football PLC. So, the purchase consideration consisted of cash of 1,460,000,000 naira. At the acquisition, the fair value of non-controlling interest in Football PLC was 590 million naira. On October 1st, 2018, the fair value of the identifiable net assets acquired was 1,670,000,000, and retained earnings of Football PLC were 638 million naira. And other components of equity were 54 million naira. The excess in fair value is due to non-depreciable land. Note 2. On October 1st, 2019, Football PLC acquired 80% of the equity interest of Volleyball PLC. It is Football PLC that now acquire the Volleyball PLC. So, Football PLC acquired 80% of Volleyball PLC. Sports PLC acquired a 14% interest in Handball PLC. So that means Sport again acquired 14% in Handball PLC on October 1st, 2018 for a cash consideration of 36 million naira. The investment was accounted for under IFRS 9. No, this is simple investment. 14% is a simple investment, and that should be accounted for in accordance with IFRS 9 financial instruments. Remember, equity financial instruments will either be accounted for or recognized as a fair value through profit or loss, or as a fair value through other comprehensive income. If you have watched my earlier presentation on IFRS 9, I've told you that the default is a fair value through profit or loss. By default, I mean where the examiner did not tell you how it should be recognized. You should recognize it as fair value through profit or loss. Where you are expected to recognize it as a fair value through other comprehensive income, you'll be told in the question. Now, and was designated as fair value through other comprehensive income. So you were told it is designated as fair value through other comprehensive income. On April 1st, 2020, Sport PLC acquired additional 16%. So that means you are now increasing the holding from 14% to 30%. 14% plus 16%, that will be 30. So that means the 30% is no longer a simple investment, but a significant influence. That is an associate. An investment in associate should be accounted for using equity accounting method. So now 14% plus 60%, 16%, that is 30%. No, it is sports that acquire handball. So now let's include that in our group structure. This is sports PLC, this is volleyball, and this is football. So the handball is not among the three entities. So that means since sports acquire handball, so you have sports acquired 30% in handball. Remember we said he had 30% is 14% plus 16%. That is how we got the 30%. That information they found in additional information number 4. So we have handball. So it means sports PLC acquired 60% in handball PLC. Now, we draw the group structure. The next thing is to determine the effective interest of Sport PLC in Volleyball PLC. You want to determine the effective interest of parent company in the sub-subsidiary. So, effective interest of Sport PLC in Volleyball PLC. Remember, Sports PLC does not have a direct holding, does not have direct investment in volleyball. So you will have Direct is nil. Direct, nil. Then sport is only having indirect. It's having indirect control of volleyball. So we have indirect. Indirect, which is 70% times 80%. 70% by 80%. That gives us 56%. 56%. That means the NCI we own, if you subtract 56% from 100%, then you'll be left with 44%. NCI we own 44%. Total will be 100%. That is the effective interest of Sport PLC in Volleyball PLC. After the group structure, the next thing is to present the summary of Football PLC net asset. Working 2. Summary of Football PLC net assets. So you have post acquisition period. You have the date of acquisition. Then you equally have date of consolidation. Amount is in million. You have million naira. Then the post acquisition period. If you check the equity section, you have retained earnings separate, retained earnings. Then you also have other component of equity. The OCE mean other components of equity. RE, retained earnings. Now, let's go through the equity section of the statement of financial position. This is Football PLC. The equity of Football PLC comprises ordinary share capital 800, other components of equity 74, retained earnings 884. We have ordinary share capital, So that of Football PLC, we have 800. Then other components of equity, other components of equity, and that amounted to 74. Then we also have retained earnings. All these figures were lifted directly from the statement of financial position. We have 884. The ordinary shares in DOA column will still be 800. Whatever you have in DOC is what we will have in the DOA. So then we are left with other components of equity and retained earnings. Let's go through the notes. Note 1. On October 1st, 2018, Sport PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash of 1,460,000,000. At acquisition, the fair value of non-controlling interest in Football PLC was 590 million. On October 1st, 2018, the fair value of the identifiable net assets acquired was 1,670,000,000. This is the fair value of the net asset at the date of acquisition. So since we are given the fair value of the net asset, so it means the total net asset at the DOA must be equal to this. And retained earnings of Football PLC were 638 million. Retained earnings at the date of acquisition we have 638. And other components of equity were 54 million. So other components of equity 54 million. Other components of equity 54 million. So you were told the excess in fair value is due to non-depreciable land. Remember, you were told the fair value should be total 1,670,000,000. If there is excess, the excess you should attribute it to non-depreciable land. So we have no fair value of non-depreciable land. Never knew how much that would be. And the total should be 1,670,000,000. Now, the post-acquisition other components of equity, 74 minus 54, that will be 20. You put it under other components of equity. Then retained earnings, 884 minus 638. Then retained earnings of 246. You put that under retained earnings. Then let's total this. 800 plus 54 plus 638. And that is totaled 1,492. And you were told the total should be 1,674. This is greater than the total of this. The total of this is 1,492, which is lower than this. So the difference, you have to attribute it to the land. Let's subtract 1,670. If you subtract it, you have 178 as the difference. Then the same amount you have, you must include it in the DOA column, 178. We don't use to depreciate land. Since land is not to be depreciated, that means you will not need to charge any subsequent or under depreciation. So we have 800 plus 74 plus 884 plus 178. And this is total 1936. That is all about that note. Now let's go through the notes too. On October 1st, 2019, Football PLC acquired. This is about football. It doesn't have anything to do. Okay, it is football that acquired another entity. No, it is sport that acquired football here. But this time around, it is football that acquired volleyball. So the summary of net assets of football will not contain information you have here, because this will be needed to calculate the summary of net asset of volleyball. So this one has nothing to do with the football. Let's go through the note 3. Note 3, both football PLC and volleyball PLC were tested for impairment as of September 30, 2020. That is, they were tested for impairment at the year end. The recoverable amount of both cash generating units as stated in the individual statements as of September 30, 2020 were football 2,850,000,000 and volleyball 1,208,000,000 naira respectively. So this information, you are given the cash generating unit, you are not given the impairment loss. Remember, I've told you, if you have watched my earlier videos on group account, that where the group policy is fair value, that is full goodwill method, that you should use the impairment or you should charge it in the summary of subsidiary net asset. But where the group policy is proportionate share of subsidiary net asset, if it is proportionate method, that you will not need to use the impairment loss here, you deduct it from the retained earnings of the parent company. So I've told you, because some students have been asking me, I think it should be shared. Yes, it should be shared. By deducting it from the subsidiary net asset, you are indirectly sharing it. So because if you don't want to deduct it in the summaries of subsidiary net asset, you can use the percentage of acquisition to share it between the parent company and the NCI. The parent share of that impairment loss, you deduct it from the parent company's retained earnings, while the NCI share of it, you deduct it from the NCI calculated in usual way. But to avoid all those complications, I said where the policy is fair value, always deduct the impairment loss from the summary of the subsidiary net assets. At the same time, you deduct it from the goodwill that will be calculated. We've not calculated our goodwill. It is the group's policy to measure the non-controlling interest at fair value at the date of acquisition. The policy of the group is expressly stated to be fair value. Since the policy is fair value, that means any impairment loss will be charged against the profit of the subsidiary in the summary of subsidiary net assets. Since the policy is fair value, I've told you where the policy is fair value, that you should always deduct the impairment loss in the summary of subsidiary net assets. So let's have impairment loss. Though the impairment loss have not been calculated, since we've not calculated the necessary things we need, and you were given the fair value of the cash generating units. It is the fair value of the cash generating units you were given, and not the impairment loss. So after charging the impairment loss, then you will arrive at the amount that will be used. Working number 3. So summary of volleyball PLC net assets. So you have post acquisition, you have DOA, date of acquisition, date of consolidation. Your post acquisition, we want to divide it into 2 because you have a column for other components of equity and another column for retained earnings. So that is why we want to divide the post acquisition into 2: retained earnings, other component of equity, amount in million naira. So we have ordinary share capital, other components of equity, and retained earnings. Ordinary share capital. We have other components of equity. Then we also have retained earnings. Ordinary share capital of volleyball, we have 400, other components of equity 50, retained earnings 278. We have 400, 50, and 278. So what you have as ordinary shares in DOC, the same amount will be repeated in DOA column. Note 2. On October 1st, 2019, Football PLC acquired 80% of the equity interest of volleyball. This is volleyball PLC for cash consideration of 640 million naira. The fair value of 20% holding of the non-controlling interest was 144 million naira. A 30% holding was 260 million, and a 44% holding was 322 million. At the date of acquisition, the fair value of the identifiable net asset of volleyball was 724 million. This is the fair value of net asset at the date of acquisition. That means the total of everything you will have in DOA column will be total 724 million. Retained earnings were 212 million. The retained earnings at the date of acquisition 212. And other components of equity were 40 million. Other components of equity that amounted to 40 million. So now let's read further. The excess in fair value is due to non-depreciable land. So any fair value difference, fair value attributable to non-depreciable land, if any. So remember, the total DOA, net asset at the date of acquisition, is amounted to 724. So you have 724 million. Now let's total this to see if there could be difference. 440, 400 plus 40, that is 440 plus 212. So we have 652. If you subtract it from 724, then you have 72. That 72 is the fair value. If you add it, the DOC is a memorandum column. It does not form part of the double entry. So let's total this. So this is totaled 800. Land is not a depreciable asset, so you don't need to charge any depreciation. And if you have impairment loss, since the policy is fair value, so you will charge it in the summary of subsidiary net asset. So if any, if you have impairment loss, you deduct it here. So now let's go through the other notes. In order to ascertain it, there are other notes that have to do with volleyball. There are no other notes or additional information that affect volleyball apart from note 3, where you are given the cash generating units. So before anything can be done on that note 3, you must have calculated the goodwill before we can determine the amount of impairment loss that will be allocated to the cash generating units in accordance with IAS 36. What is the difference between 15 and 40? 15 minus 40, we have 10. The post-acquisition other components of equity amounted to 10 million. 278 minus 212, that gives us 66. The post-acquisition retained earnings amounted to 66 million. So this is 10 and this is 66 million. If there are impairment loss, we will charge that. So now let's start the consolidation. Other adjustments will be done along with our consolidation. So the name of the parent is Sports PLC. So we can have Sports PLC Group. Consolidated statement of financial position as at September 30, 2020. So now the starting point is our assets, and the first asset should be non-current asset. As part of our non-current assets, we have property, plant and equipment. Property, plant and equipment. Working number 4, acquisition of football PLC. So we want to calculate goodwill on acquisition of football PLC. To calculate goodwill, the starting point is purchase consideration. Purchase consideration. And how much was the consideration paid by Sport PLC in acquiring football PLC? On 1st October 2018, Sport PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash of 1,460,000,000. So we have cash consideration 1,460. That is the cash consideration. At acquisition, the fair value of the non-controlling interest in Football PLC was 590 million. So we have fair value of non-controlling interest, and that amounted to 590 million. So by the time you sum them up, 1,460 plus 590, that is totaled 2050. 2050. Then the next item is to deduct the fair value of the subsidiaries' net asset at the date of acquisition. Fair value of net assets at the date of acquisition, DOA, date of acquisition. Now, let's go to the summary of Football PLC net assets. The summary of Football PLC net asset, DOA, we have net asset total 1,670. 1,670. So you subtract 1,670. Then you have the goodwill. 2050 minus 1,670. Then we have goodwill of 380. That is goodwill. So we've not known the amount of impairment loss, if any, that will be charged, because you are given the cash generating unit that is in note 3. Now, let's have working number 5. Let me just create a space for impairment loss. Impairment loss, so that we'll be able to deduct that, if any, that will be charged against that goodwill. Working number 5. We want to calculate goodwill on acquisition of volleyball. Acquisition of volleyball PLC. Volleyball PLC. Remember to calculate goodwill. The starting point is the purchase consideration. Purchase consideration. So remember, volleyball is the sub-subsidiary of Sports PLC. And I've told you that the consideration paid by football to acquire the volleyball, I said it will be apportioned between the parent company and the non-controlling interest. The parent company shares of that consideration is what will be used to calculate goodwill. And the NCI share of the consideration will be used to reduce the NCI calculated in the usual way. So, how much was the consideration paid by football in acquiring volleyball? Note 2. On October 1st, 2019, Football PLC acquired 80% of the equity interest of Volleyball PLC for cash consideration of 640 million naira. So 640 million naira was the consideration paid by football in acquiring volleyball. So I've told you it is the percentage of the parent company that will be used to apportion it. The parent company's stake in football is 70%. The stake of Sport PLC in football is what will be used to apportion it. Now that means Sport's share of that consideration will be 70% of 640 million. 70% of 640 million. So that gives us 448 million. The next item is the fair value of non-controlling interest. Remember, You were told in note 2 that on 1st of October 2019, Football PLC acquired 80% of the equity interest of Volleyball PLC for cash consideration of 640 million naira. The fair value of 20%, that is when 80% was acquired, then you have 20%. The fair value of 20% holding of the non-controlling interest was 144 million. That is not the right fair value to use. A 30% holding was 260 million. That is, remember, what football acquired in volleyball is 30%. And it is not that proportion we need as well. So if you look at the effective interest, so the effective interest, we have indirect interest of 56% and 44% is attributable to NCI. It is the fair value of 44% we need, not the fair value of 20%, nor the fair value of 30%. So on the basis of that, let's read further. A 30% holding was 260 million and a 44% holding was 322 million. It is the fair value of 44% holding we need. So fair value of 44% non-controlling interest, and that is given to be 322 million naira. So we have 322. So if you add it to the consideration of 448, so we have 448 plus 322, then we have 770. 770. So then the next item is to deduct the fair value of net assets acquired. That is net assets at the date of acquisition. The fair value of net assets at the date of acquisition. Let's go through the summary of Volleyball PLC net assets. You have the DOA. And the net assets at the date of acquisition, the fair value is total 724 million. So we have 724 million. So if you deduct 724 from 770, then you have 46 million. That is the goodwill on acquisition of volleyball. Then after that, you deduct impairment loss, if any. Impairment loss, if any, will be charged against the goodwill of Volleyball PLC. Now, let's go and calculate our impairment loss, since the recoverable amount of the cash generating units was given. We are not given the impairment loss directly in the question. You are given the recoverable amount of the cash generating units. Working 6. Calculation of impairment loss. Calculation of impairment loss. We have acquisition of football and that of volleyball. Volleyball PLC. Then we equally have football PLC. Amount in million. Now, let's go through the statement of financial position of each of the entities. Then in the statement of financial position, you have total assets. From the statement of financial position, football total asset is 2260. That of volleyball is 1190. Total assets of football is 2260. Now that of volleyball amounted to 1190. 1190. Then we have the calculated goodwill. On acquisition of the subsidiaries. The goodwill on acquisition of football PLC amounted to 380. And that of the volleyball is 446. So we have 46 as the goodwill on acquisition of volleyball. So football 360, volleyball 46. Then from the calculation of from the summary of the subsidiaries net asset, subsidiary net asset, we have fair value of not depreciable land 178 for football, that of volleyball is 72. We have 148 for football and 170 for football and 72 for volleyball. So we have fair value attributable to non-depreciable land. Football 178, volleyball we have 72. So if you sum up this, you have the total asset 2260 plus 360 plus this is goodwill 380, not 360. 380 from our calculation working number 4, working 4 and 5. This is from summary of net asset working 2 and 3. Working 2 and 3. Total 260 plus 380 plus 178. We have 2,818. For volleyball, 1,190 plus 46 plus 72. That is totaled 1,308. Now, let's go through additional information number 3. You were told both football PSC and volleyball PSC were tested for impairment as at September 30, 2020. The recoverable amounts of both cash generating units are stated in the individual statements as at September 30, 2020 were football 2,850, that is 2,850,000,000, and volleyball 1,208,000,000 respectively. So you are given the recoverable amount to be this and this for football and this for volleyball. Now, you want to compare the carrying amount with the recoverable amount. This is the carrying amount of the cash generating unit. Carrying amount is this. The recoverable amount from additional information number 3. We have 2,850 and 1,208. 1,208. So if you compare the recoverable amount of football, 2,850 is greater than 2,818. So it means football was not impaired. So impairment loss. It is not impaired because the recoverable amount of the cash generating unit is greater than the carrying amount. But here, the carrying amount is greater than the recoverable amount by 100. The difference between the two, 100. So that's to show that volleyball has been impaired by 100. We were told the directors of sports PSC felt that any impairment of assets was due to poor performance of the intangible assets. So that means the impairment loss was due to poor performance of intangible assets. So now, remember, goodwill is part of the intangible assets. If you look at IAS 38, IAS 38 intangible assets are the identifiable non-monetary assets. without physical substance. Identifiable non-monetary assets without physical substance. That is intangible assets. So goodwill is one. So if the impairment loss of 100 for volleyball, if it is due to poor performance of intangible assets, that means the goodwill of 46 we have here will be fully impaired. If you allocate impairment loss, part of the impairment loss to goodwill 46, then that means the consolidated goodwill here will be nil. Now, any other intangible assets we have for volleyball, apart from goodwill, will absorb the remaining 100. So we have other intangible assets would be impaired. Impaired by 54 million naira. That is 100 minus 46. 100 million minus 46 million. So it means if you have any intangible asset, then you will impair that by 54 million. Since of the 100 million you have, 46 million has been allocated to goodwill. Goodwill in football was not impaired. Since there is no impairment loss attributable to football, since football was not impaired, that's to show that the goodwill on acquisition of football will not be impaired. So the impairment loss of football will be nil. If that is nil, the goodwill that will be consolidated in respect of football will amount to 380 million naira. Now let's go to the consolidated statement of financial position in order to include the 380 million naira there. Since volleyball has been impaired by 100 million, remember this 100 million was shared between goodwill, or the 100 million is to be shared between goodwill and other intangible assets. That means you are crediting goodwill with 46 million, then you are crediting other intangible assets with 54 million. Then the whole of the impairment of the debit entry will now goes to the retained earnings. So you have 100. So everything you have here, we have fed the DOC. Now, 800 minus 100, then you have 700. This is 724. This is 10. And this is 66 minus 100. Then you have 34. Working number 7. Working 7. So property, plant, and equipment. We have the parent is Sport PLC. From the statement of financial position of the parent, we have property, plant, and equipment 1840. That is the first item obtained from the statement of financial position. Then we have football PLC. So we have 600. Then we equally have volleyball PLC of 620. Then from additional information number 6, we have disposal group. The PP from note 6. From note 6. We have 36. We will subtract that 36 million. That is what we have as PPE. Now, from the summary of subsidiary net assets, you have fair value of non-depreciable land 178 for football 178, fair value of non-depreciable land, that of football. This figure was obtained from note 2, from working 2. That is where the figure was obtained from 178. The fair value of non-depreciable land, and from working number 3, we got 72 million. 72 million, that is the fair value of non-depreciable land of 72 million. So, if you now sum up everything, 72 million, then the total will be 1840 plus 600 plus 620 minus 36 plus 178 plus 72. So we have 3,274. 3,274. After this, we have goodwill on acquisition of football from working number 4. Working number 4, acquisition of football. We have goodwill of 380. But goodwill on acquisition of volleyball has been fully impaired. That is why that will not be added. So we only use 380. So 380 million, that is the goodwill on acquisition of football, 380 million. The next item is investment in handball PLC. Remember, handball PLC is an associate of the sport PLC. Let's have that as working number. So number 8. So working number 8 now. Investment in handball PLC. Now, let's go through the information about the acquisition of handball PLC. Although you can see investment in handball PLC of 96 million in the statement of financial position. Or let's go through the note about the acquisition of handball PLC. So in the note 4, you were told Sport PLC acquired a 14% interest in handball PLC on October 1st, 2018 for a cash consideration of 36 million naira. So a 14% holding is not yet an associate, and that is a simple investment or ordinary investment. A simple investment will be accounted for in accordance with the requirement in IFRS 9 financial instruments. So I remember, in accordance with IFRS 9, equity financial instrument can either be recognized as a fair value through profit or loss, or as a fair value through other comprehensive income. And if you have watched my earlier lecture on IFRS 9, I've told you that the default is always at fair value through profit or loss. That means if the examiner did not tell you that it is fair value through other comprehensive income, you should always have it recognized as a fair value through profit or loss. That means the fair value gains or loss will be recognized in the face of the statement of profit or loss as other income, or income in the space of statement of profit or loss, not as OCI, not as other comprehensive income. But where the examiner want you to measure that, or where the instrument is to be designated as fair value through other comprehensive income, it will be stated in the question. So now let's read this. We said the 14% is a simple investment. The investment was accounted for under IFRS 9, yes, financial instruments, and was designated as fair value through other comprehensive income. So that means you are not going to measure it as fair value through profit or loss this time around. You have it as fair value through other comprehensive income. So it means the fair value, the gains or loss subsequent to its measurement, will be recognized as other comprehensive income. That is the meaning. Now, on April 1st, 2020, Sport PLC acquired additional 16% interest in Handball PLC for cash consideration of 54 million. Remember, this 36 million was cost, cash consideration, which is cost. And I've told you, in accordance with the provisions in IFRS 9, that the instrument should be measured as at fair value. So it means what we need now to be included in the consideration of 14% should be the fair value, not the cost. So that means our purchase consideration investment in Handball, the initial investment, which is 14%, we say it should be recognized or measured at fair value. So purchase consideration which include fair value of 14% investment. I've told you what you need is not the cost, because IFRS 9 said that financial asset, we say it should be recognized at fair value. I've told you this 36 million is not the fair value, it's the cost. So the investment was accounted for under IFRS 9, but how much is the consideration for this additional investment in Handball PLC for cash consideration of 54 million? This additional 16% investment, the consideration for that is 54 million. That will form part of the purchase consideration. So now have plus cost of 16% investment, and that is given to be 54 million from additional information number 4 from note 4. So, but what we need is the fair value of this 14% investment. So we say any gains or loss subsequent to it, remember, should be adjusted in the retained earnings. So now, how much is the fair value of this 14% investment? And achieved significant influence. So it means after additional 16% were acquired, you know, the holding has now increased from 14% to 30%. The 30% is 14% plus 16%. So you are now having 30%. So when the holding now increased to 30%, that 30% is sufficient to give a significant influence to the entity. So that means significant influence has now been achieved. So we will measure that in accordance with IAS 28, investment in associates and joint venture. Now, the value of the original 14% investment on April 1st, 2020 was 42 million. So this was the fair value we were looking for. Remember, the cost was 36 million. And the fair value has now increased from 36 million cost to 42 million. So, you know, the cost of that 14%, this is 36 million. That is the cost, cash consideration of 36 million. And the fair value of that 14% is now 42 million. The fair value of the 14% is 42 million. Of the 14% is 42 million. That means the consideration will be totaled 2 plus 4, 6, 4 plus 5, 9, 96 million. And that is what constitutes the 96 million you have in the statement of financial position. Now, in accordance with equity accounting method, investment will be recognized at cost, which is what we have done here, and adjusted thereafter for the investor share of the post-acquisition profit of the investee. So that means we will have Sports PLC share of post-acquisition profit of handball PLC. Remember, the holding have now increased to 30%. 30% being 14% plus 16%. So you have 30% of how much is the post-acquisition profit of the handball. When was the significant influence achieved? Remember, Sports PLC acquired 14% interest in handball PLC on October 1st, 2018. So as at this date, significant influence have not been achieved. So it is the latter acquisition that allows Sport PLC to achieve a significant influence in handball PLC. On April 1st, 2020, the Sport PLC acquired additional 16%. If you are in need of post-acquisition profit, it means it is the profit from April 1st, 2020 to the date of consolidation. How many months is that? April 2020, May, June, July, August, September. It shows that 6 months relates to the post-acquisition period. A period from the date of this latter acquisition that enables Sport PLC to achieve a significant influence in handball PLC. The date from which the significant influence was achieved to the date of consolidation, from April 1st, 2020 to September 30, 2020, which is the date of consolidation, which is 6 months. So it shows that 6 months relates to the post-acquisition period. Unless otherwise stated, profit is assumed to have been achieved, to have accrued evenly over the period. We assume that profit is accrued evenly over the period. Now, achieved significant influence. The value of the original 14% investment on April 1st, 2020 was 42 million. Handball PLC made a profit after tax of 40 million and 60 million for the years to September 30, 2019. Remember, as at September 30, 2019, significant influence have not been achieved. Significant influence was achieved as at 1st of April 2020. So it means this profit, the profit of 40 million, made a profit after tax of 40 million. 40 million, which is a profit as at September 30, 2020, is not the profit of the year the significant influence was achieved. So, and September 30, 2020, so, and 60 million for the year to September 30, 2019 and September 30, 2020, respectively. The profit as of September 30, 2020, that amounted to 60 million. So it is at this year, it is in this year that the significant influence was achieved. That means, remember, this profit is profit for the year. Significant influence was achieved on April 1st, 2020. Since it is profit for the year, that is to show that this profit of 60 million will be the profit from October 1st, 2019 to September 30, 2020, because you were to profit for the year. So, and Significant influence was achieved on April 1st, 2020, which is just 6 months related to the post-acquisition period. So that means 6 months of this profit from April 1, 2020 to this date, to September 30, 2020. If you count it from April 2020 to September 2020, that is 6 months. It's only 6 months profit that relates to post-acquisition period. That means we need to calculate 6 months on the profit of 60 million. I've told you, unless stated otherwise, profit is assumed to have accrued evenly over the period. So now let's take 6 months from this 60 million. We have 60 million. We need 6 months from it. That will be 30% of 60 million times 6 divided by 12. That gives us 9 million. If you add 9 millions to 96 million, then you have 105 million. Now, back to the note 5. On September 2020, Sports PLC received a dividend from Handball PLC of 4 million, which has been credited to other components of equity. Since this dividend has been credited to other components of equity, so what you do is to credit the investment in associates and debit other components of equity with that 4 million. Dividend received from associate. That is additional information 6. Additional information number 4. Additional information 4. IV. So that dividend amounted to 4 million. If you deduct the 4 million from 105 million, then you'll be left with 101. So investment from associates amounted to 101, and that will be recognized in the statement of financial position. Then after this, we have intangibles, intangible assets, intangible assets. That is working number 9. Working 9. Intangible assets. That of sports, we have 396 million. Sports PLC, 396 million. That of football PLC, football PLC, we have 60 million. That of volleyball PLC, we have 70 million. Note 5. Sport PLC purchased patents of 20 million naira to use in the project to develop new products. On October 1st, 2019, Sport PLC has completed the investigative phase of the project, incurring an additional cost of 14 million, and has determined that the product can be developed profitably. So, the investigative stage, which was completed at the cost of 40 million, that relates to that phase, is a research cost. In accordance with IAS 38, intangible assets, the project will be divided into 2 phases, the research phase and the development phase. At the research phase of the project, it is not highly probable that the project could be successful and yield positive returns. So expenditure incurred at the research phase of a project should always be spent. So that shows that the 14 million naira which were incurred at the research phase of the project does not meet the capitalization criteria as an intangible asset. Therefore, the 40 million should be spent. Now, but remember it has been included in intangible assets, so we have to remove it from there. And has determined that the product can be developed profitably. An effective and working prototype was created at a cost of 8 million. And in order to put the product into condition for sale, a further 6 million was spent. So the development cost, the 8 million and the 6 million are development costs. And those one meet the capitalization criteria as intangible assets in accordance with the provisions in IAS 38. Now, finally, marketing costs of 4 million were incurred. The marketing cost does not meet the capitalization criteria. That is a revenue expenditure, so it should be spent. So all of the above costs were included in the intangible assets of Sport PLC. So it means the 14 million and 4 million which does not meet the capitalization criteria should be spent. Cost of investigation that doesn't meet capitalization criteria, 40 million. So we remove it from the intangible asset, you would recognize it. That means you are crediting the intangible asset with debit the profit or loss. That means the same amount will be charged as an expense. We are crediting the intangible asset because it has been included in intangible asset. Then we also have marketing cost. Marketing cost of 4 million that does not meet the criteria in accordance with IFRS IAS 38. So all this information were obtained from note 4. Note 5. Note 5. Now, remember we've calculated the impairment loss. And we got 100 million as impairment loss. And of that 100 million, that is from working sales, we share the 100 million between Goodwill. We said 46 million of the 100 million will be allocated to Goodwill. While the other ones, other impairment loss, we said that will be allocated to intangible assets. So we have impairment loss. That is 100 million is the total impairment minus 46 million which was allocated to Goodwill. Then you are left with 54 million. That 54 million will be allocated to other intangible assets. So we have 396 plus 60 plus 70 minus 14 minus 4 minus 54. So we have 454. 454. That is the amount of intangible assets that will be recognized in the consolidated statement of financial position. Then we are done with non-current assets. So we can sum up our non-current assets in order to get the total assets. So 3274 plus 380 plus 101 plus 454. So we have 4209. 4209. That is the total of our non-current assets. After non-current assets, then the next assets are the current assets. We have current assets. Current assets. And our current asset, we have 1790 plus 960 plus 500. Then go to the additional information number 6. Number 6, we have the disposal group in note 6. So you were told Sport PLC intends to dispose of a major line of the patents business operations at the date the held for sale criteria were met. The current amount of the assets and liability consisting of the line of the business where you have the property, plant, and equipment which shall be removed from the PPE. Then inventories is part of current asset, 98 million. We have to subtract this amount from our current assets minus 98 million. So you have 1790 plus 960 plus 500 minus 98. So we have 3152. After this, as part of current asset, in accordance with IFRS 5, we have disposal group. And how much was the consideration received on disposal? Back to note 6. So you were told from note 6 that Sport PLC intends to dispose of a major line of the patents business operations at the date the held for sale criteria were met. The current amount of the assets and liabilities consisting of the line of business where you have the current amount of the assets and liabilities as given. This and this have been used. It is anticipated that the Sports PLC will realize 60 million naira for the business. No adjustments have been made in the financial statements in relation to the above decision. The proceeds of 60 million should be recognized as current assets. 60 million. You can add the liability because you want to show the liability separate. So that is why you add the liability. So we have the proceeds of 60 plus 6 million. That gives us 66 million. 60 million plus 6 million liability. So we have 66 million. So when you sum up all this, you have the total of our current asset, 3152 plus 66. You have 3218. That is the total of the current asset. You add the current and the non-current asset. Remember, our non-current asset is totaled 4209 plus 4209. So we have 7427. This is our total assets. After total assets, the next section will be equity and liabilities. So the equity section of the statement of financial position, we have ordinary share capital, ordinary share capital, that of the parent only. Since there are no share consideration, you have 1840 parent company ordinary share. After that, we have other components of equity. Other components of equity. Working term, other components of equity. You start with that of the parent, and the name of the parent is Sport PLC. Sport PLC, other component of equity. OC mean other component of equity. Sport PLC, other component of equity as per statement of financial position. Now, let's go through the statement of financial position. How much is the other components of equity of Sport PLC? We have other components of equity. Sport PLC 146. So we have 146 million. So 146 million. Then we now have Sport PLC. PLC, share of other component of equity of the first entity is Football PLC. Football PLC. Remember, what parent acquired, what Sport acquired is 80%. 80% of. Now let's go to the summary of subsidiary net assets in order to ascertain how much is the post-acquisition other component of equity. So this is let me bring down the total 1936. Here, other component of equity you have 20, and post-acquisition you have 246. So the other component of equity is 20 million. So we can share it. Parent will receive 80% of that 20 million. So we have 20 million. 80% of 20 million, that gives us 16 million. That of volleyball, you use the effective interest, which is 56%, as calculated from working one. Effective interest of sport in volleyball, that is what will be used. Now, the summary of volleyball's net asset, you have other component of equity totaled 10 million. Other component of equity 10 million. So you have 10 million. 56% of 10 million. That gives us 5.6 million. Now, let's go through the additional information. From note 4, we were told on September 2020, Sport PLC received a dividend from Handball PLC of 4 million, which has been credited to other components of equity. So this dividend was deducted from the investment in associate. That means it was credited to investment in associate. The second leg of it is to debit other component of equity. To debit other component of equity, that means you are going to subtract 4 million naira from other components of equity in line with the double entry principle. For every debit entry, there must be a corresponding credit entry. You credit investment in associate, you debit other components of equity. Now let's post that. So we have dividend received from associate. Dividend received from associate. That is from note 4, note IV. And that dividend amounted to 4 million. We subtract it. So, after this adjustment, 146 plus 16 plus 5.6 minus 4. You have 163.6. 163.6. 163.6 million naira. From note 4, you were given the financial asset that was recognized in accordance with IFRS 9. The cost is 36 million, while its fair value is 4 million. And you were told it is to be recognized as fair value through other comprehensive income. Since it is recognized as fair value through other comprehensive income, that means we will need to adjust that in other components of equity. So we have fair value fair value gains on equity financial asset. Financial asset. This is information is captured in note 4. Note 4 IV. That is the difference between 42 million, which is the fair value, minus the cost of 36 million. You have difference of 6. It is this 6 million that will be deducted from other comprehensive income. So after this adjustment, how much will you have? 146 plus 16 plus 5.6 minus 4 minus 6. So we have 157.6. Let me recast that. 146 plus 16 plus 5.6 minus 4 minus 6. Then you have 157.6. 157.6. The percentage of sports PLC stake in football is not 80%, it's 70%. So let me make that correction here. Please note this. It has been corrected. 70% of 20 million, that is 14 million. Please note the correction. So we have 146 plus 14 plus 5.6 minus 4 minus 6. You have 155.6. 155.6 million. So this amount will be recognized as other components of equity in the consolidated statement of financial position. So we have 155.6. That is working number 10. Then after the other components of equity, the next item we have is retained earnings. Retained earnings. Let's have that as working 11. Working number 11, we have retained earnings. Retained earnings. We have Sport PLC, which is the name of the parent. Sports PLC retained earnings as per statement of financial position. Let's go through the statement of financial position of Sport PLC. How much is their retained earnings? We have retained earnings amounted to 1,790. So the Sport PLC retained earnings as per the statement of financial position is 1,790. 1,790. We now have Sport PLC, share of adjusted post acquisition retained earnings of, we have Football PLC. The stake of sport in football is 70%. 70% of the adjusted post acquisition retained earnings of football. We have that amounted to 246 million. So we have 246 million. So 70% of 246 million. That gives us 172.2 million. That of volleyball, we use the effective interest, which is 56% as determined from working one. 56% of how much is the adjusted post-acquisition retained earnings of volleyball. From the summary of volleyball's net asset, we have a net loss of 34 million. 34 million loss. So if you calculate 56% of 34 million, that gives us 19.04 being a loss, so you have to subtract that. Then that of handball. Handball is an associate. The stake of sport in associate is 30%. The post-acquisition profits of associate. Remember, the profit for the year is given to be 60 million, and for 6 months, just the same workings I've shown earlier. So you have 30% of 60 million times 6/12. That is 9 million. So we have 9 million. Those costs that does not meet the capitalization criteria as an intangible asset in note 5 will be expensed. So we said the 40 million, which was incurred in the investigative phase, and the advertising or marketing cost of 4 million rather, we said that should be expensed. So now let's have investigative cost. Investigative cost of 40 million. The marketing cost. All this information were provided in note V, note 5. Marketing cost of 4 million. So that marketing cost, this is it. So that is the amount expensed here. Then note 6, we have Sport PLC intends to dispose of a major line of patents, business operations. At the date the held for sale criteria were met, the carrying amount of the assets and liabilities consisting of the line of business were, you are given the carrying amount: property, plant and equipment 36 million, inventories of 98 million, and current liabilities of 6 million. And you were told it is anticipated that Sport PLC will realize 60 million for the business. No adjustments are being made in the financial statements in relation to the above decision. So we need to calculate the profit or loss on disposal unit, or we want to calculate the impairment of disposal unit. Now let's have working number 12, working 12. Calculation of impairment of disposal unit. You are given the proceed, realizable value, sales proceed to be 60 million. 60 million. Now less carrying amount of the unit. Less the carrying amount of the unit. So, and the carrying amount include, you know, the proceed is 60 million, which have been recorded. The carrying amounts include PPE 36, inventories 98, current liability 6 million. So we have the carrying amount, which include PPE of 36 million, inventories of 98 million. Then we also have current liabilities. Current liabilities of 6 million. So 36 plus 98 minus 6. You have the carrying amount is 128 million. And it was 60 million, it was realized for 60 million. That means there is an impairment loss because the carrying amount is greater than the market value. So impairment of 68 million. So we have impairment loss. And this impairment loss of 68 million will be adjusted in the retained earnings. So we have impairment loss, impairment of disposal group, disposal unit or disposal group. We have 68 million. So we deduct that. Then we have the gains on equity financial asset, which has been debited to the other components of equity. Since that gain has become realized, then we will credit retained earnings. Know that gain is 6 million, which was debited to equity, other components of equity, fair value gains on equity financial assets, 6 million, which was debited to other components of equity. It will be credited to retained earnings. So we have realized gain on equity financial asset. Realized gains on equity financial assets. Though the fair value is 42 million, the cost is 36 million, and we got 6 million. This gain has been debited to other components of equity, then we will credit retained earnings. Now let's total it. 1790 plus 172.2 minus 19.04 plus 9 minus 14 minus 4 minus 68 plus 6. So we have 1872.16. So this will be recognized in the consolidated statement of financial position. Note 13, working number 13. So non-controlling interest. The starting point for the calculation of non-controlling interest is the fair value of non-controlling interest at acquisition of when football was acquired. Football. Remember, Sport PLC acquired 70% of Football PLC. That means 30% will be attributable to NCI on acquisition of football. Now, let's go through the additional information. Number one, in note one, we were told on October 1st, 2018, Sport PLC acquired 70% of the equity interest of Football PLC. The purchase consideration consisted of cash of 1,460 million. At acquisition, the fair value of the non-controlling interest in football was 590 million. So the fair value of non-controlling interest on acquisition of Football PLC amounted to 590 million naira. Then, on acquisition of volleyball PLC, remember, we have determined the effective interest on acquisition of volleyball PLC, and we found NCI to be 44%. So it means the NCI will be interested in the NCI at 44%. So we are looking for 44% NCI, fair value of 44% NCI. Go through the additional information. Number two, we were told on October 1st, 2019, Football PLC acquired 80% of the equity interest of Volleyball PLC. We are not looking for, since acquisition in volleyball by football is 80%, NCI we are interested in is not 20% NCI, because as I determine effective interest of sport in volleyball were determined, we obtained 56%. Therefore, 44% was attributable to NCI. For cash consideration of 640 million naira, the fair value of 20% holding of the non-controlling interest was 144 million. The fair value we are interested in is not 20%, so that 20% fair value of 20% holding will be ignored. It is not relevant. A 30% holding was 216 million. So it is not 30% we are looking for on acquisition of volleyball. So we ignore that. Means the fair value of 30% holding was not equally relevant. And the 44% holding was 322 million. The fair value of 44% holding amounted to 322 million. That is the one we are interested in. So now, after the fair value of NCI on acquisition, the next thing is the NCI share of the adjusted post-acquisition retained earnings. So now let's have NCI share of adjusted post-acquisition retained earnings of the first entity is Football PLC. We have Football PLC as the subsidiary. Remember, what the stake of Sport PLC in the football is 70%. 30% is attributable to NCI. So we have 30% of how much is the adjusted post-acquisition retained earnings of Football PLC. Now let's go through the summary of Football PLC net asset in order to ascertain that. So this is the summary of Football PLC net asset. This is other components of equity. This is retained earnings. The fair value of the post-acquisition retained earnings, adjusted post-acquisition retained earnings of Football PLC amounted to 246 million. Of these 246 million naira, Sport PLC will receive, 30% or 246 million naira will be attributable to NCI. So we have 246 million. So 30% of 246 million, that gives us 73.8 million. 73.8 million. Then that of volleyball PLC, volleyball PLC. Remember the percentage attributable to NCI on acquisition of volleyball after the effective interest of sports PLC in volleyball PLC was determined. 44% was attributable to NCI. So you have 44% of the adjusted post-acquisition retained earnings of volleyball PLC. Now let's go through the summary of volleyball PLC net asset. So this is the summary of volleyball PLC net asset. That is from working 3. Then this is retained earnings. And we have a loss of 34 million. So 34 million loss. Then of this 34 million loss, NCI will receive 44% shares of that. So 44% of 34 million. That gives us 14.96. 14.96 negative, since that is a loss. Then NCI share of other components of equity of the first entity is football PLC. NCI percentage is 30%. 30%. Now let's go through the summary of football PLC net asset in order to ascertain the other components of equity. So now other components of equity from the summary of football PLC net asset amounted to 20 million. Of this 20 million, NCI will receive 30%. So we have 30% of 20 million. That gives us 6 million. Then that of volleyball PLC. Volleyball PLC. Percentage attributable to NCI is 44%. How much is the other components of equity of volleyball PLC? Now let's go through the summary of volleyball PLC net assets. We have 10 million. 10 million is the other components of equity on acquisition of volleyball PLC. Of this sum, NCI will receive 10% of that. What is 10% of 44%? I mean, NCI received 44% of that. 44% of 10 million, that gives us 4.4 million. 4.4 million. Remember, I've told you that the investment of football PLC, investment of the subsidiary in the sub-subsidiary company, I said it will be shared between the parent company and the NCI. Investment, football is the subsidiary. Investment of football PLC in volleyball PLC will be shared between the parent company and NCI. The parent company's share, that is, which is the 70% shares of the consideration, and the consideration was given in the note 2, additional information number 2. So 70% of it was used in calculating goodwill on acquisition of volleyball. While the remaining 30% of the 640 million will be used to reduce the non-controlling interest. Now, our non-controlling interest, now let's reduce it by 30%. Investment in volleyball PLC. So 30% of it, since parents acquired 70% in football, it is the percentage of the parent, which is 70%, 30. NCI has 30%. It is the percentage of the parent that will be used to share it. Parents own 70%, NCI owns 30%. 30% of the 640 million. 640 million. So we have 30% of 640 million. That gives us 192 million. So we subtract that 192 million from our non-controlling interest. Having calculated the non-controlling interest, now let's sum this up. 590 plus 322 plus 73.8 minus 14.96 plus 6 plus 4.4 minus 192. So we have 789.24. 789.24. So that is the non-controlling interest that will appear in the consolidated statement of financial position. So the retained earnings that will appear in the consolidated statement of financial position amounted to 1,872.16. 1,872.16, that is the retained earnings. 1,872.16. Now, let's sum up the equity attributable to the owners of the parent. 1,840 plus 155.6 plus 1,872.16. So we have 3,867.76. That is the equity attributable to the owners of the parent. The next item after this should be the non-controlling interest. Non-controlling interest, and this has been calculated from working number 13. Now, working 13. The non-controlling interest that will appear in the consolidated statement of financial position amounted to 789.24. 789.24. 789.24. By the time you add that to the equity attributable to the owners of the parent, you have the total equity to be 4,657 naira. That is the total equity. After the total equity, then we have the non-current liabilities. Non-current liabilities. Non-current liabilities. Our non-current liabilities include 990 for Sport PLC plus 246 for football and volleyball. We have 186. There is no adjustments on this. Let's just sum them up. 990 million plus 246 million plus 186 million. We have 1422. That is non-current liabilities. After the non-current liabilities, then we have the current liabilities. Current liabilities. Current liabilities. We have 816 plus 256 plus 276. Then go through the note 6, disposal group, in accordance with IFRS number 5. So you were told. So at the day held for sale criteria were met. The carrying amount of the assets and liabilities consisting of the line of business were, you have the property, plant and equipment, 36 million, inventories, 96, current liabilities, 6 million. This 6 million will require adjustment in our current liabilities. So as a disposal group, so we have minus 6 million. So if you subtract that, you have 816 plus 256 plus 276 minus 6. Then you have 1342. Then that same 6 million you subtracted here must be disclosed separately in accordance with IFRS number 5. Let's have discontinued operations. And that amounted to 6 million. So if you sum up the liabilities, one 1422 plus 1342 plus 6, we have 2,770. That is the total liabilities, 2,770. If you now add the liabilities to the equity, plus 4657. So we have 7427. 7427. That is total equity and liabilities. If you compare the total equity and liabilities with the total asset, you will see that it agrees with the total asset of 7427. Since it agreed, that means our account balanced. This marks the end of the solution to this question. Please drop the love emoji, like the video, also share it with others. Thanks for watching ZICA.